Dario, welcome back to Face. We're lucky to have you with us.
Hi.
Appreciate appreciate it. Oh, I
Oh,
did I
I
mute
was
you?
muted. Yeah,
You're
you
good,
muted me.
right?
I'm back now. It's fine.
All right, Dario. So what's top of mind for you, Dario? With let's say our discussion today has kind of been about, well, it has been about that the market may have gotten the whole thing wrong on the Brookings statement speech by Powell. What do you think?
Um, in the sense that I missed a lot of the discussion. In the sense that it was interpreted as being a very dovish.
Yeah,
Yeah,
right.
I get the impression that the Fed would love to slow the pace of tightening at this point, but it's not really in control of this. It's got an inflation problem. It's obviously watching the CPI data incredibly closely. We get another CPI reading just before the meeting. Um, I think they would like to slow down. I think that they've done a lot of tightening and they're desperate to actually assess the impact this tightening is having on the economy. Pretty much everyone is expecting some kind of slowdown or recession next year. And they always talk about these sort of long and variable lags in monetary policy. So they would
Yeah.
like to take that opportunity to just sort of assess what's been happening, but it's just a question of whether the data will actually allow them. But I didn't sense anything that was sort of overtly dovish last week. I thought it was
All
a
right.
pretty clear explanation of the way that the Fed has been thinking and this focus on the labor market and the idea that, over the last sort of 2 years, they couldn't really control most of the things that were driving inflation higher, but they see this fundamental imbalance in the economy, in the labor market. And that they're very much focused on trying to restore that balance of labor demand and labor supply in the labor market. And that's where they see the sort of medium term risk to inflation. But just in terms of the pace of tightening, I think that's very much conditioned by the CPI. And then the state of the labor market probably, determines where they get to in terms of the terminal rate.
Okay. And so as far as yields came off pretty good during the speech, they have been for over a month now. Do you look for a continuation, or is this just a correction in the 10-year yield and 435 is not the high in the 10-year yield?
Well, I'm a sort of massive bond bear. I think that we're at the start of this sort of secular bear market in bonds.
Okay.
But I think there's going to be a lot of up and downs, and we've seen enormous volatility in the economy, enormous volatility in inflation. It wouldn't surprise me if terminal rates drifted a little bit lower on a sort of
Okay.
trading horizon. But I think, I'd be very reluctant to get into bonds just because I think the next sort of 5 years for bonds are just going to look horrendous.
Okay.
It's not that we're in this sort of massive secular inflation outbreak, but we're going to get an incredible amount of volatility in
Supply?
inflation.
How about
Yeah, well, we're going
supply
to get.
being the issue?
I think this year. This year's been an absolute disaster for investors because you've had, 15% off sort of returns in equities, 15% off bonds, and that combination is the worst performance we've had for bonds and equities in 150 years. And I think that people have looked at that and they've sort of created these very bearish narratives about the sort of medium term and where we're headed. But I think really 2022 was a sort of taste of what we're going to get more often. So it's not that we're going to be in this sort of new normal of stagflation, but I think we're going to have a lot more periods of stagflation looking forward. That sort of great moderation that we lived through over the last 30, 40 years where inflation was always low and always stable. I think that's gone. When you look at
Yeah.
deglobalization and climate change, regardless of what we do with climate
Supply
change,
chains,
supply
everything, right?
chains, it's
Yeah.
all, what gave us the great moderation? It was effectively super efficient supply chains
Right.
and, a series of positive supply shocks. And that's gone. And, the sort of best case scenario is just volatility. And even volatility is going to be volatility of inflation going higher. So you're going to get lots more periods of transitory inflation. And, if you're a bond investor in that environment, I think you get killed. And there's just no compensation in bonds for this. If you look at the term premium, it just hasn't moved at all. It's still negative. And in a sense, what we're seeing is a sort of reverse of what happened after the 1980s. So in the 1980s, you had very high levels of inflation, very high levels
Right.
of volatility in inflation, and then as inflation came down, it took bond investors a long time to want to get back into bonds because they've been so badly burned, and they didn't see that the regime change that was happening. I think we're almost seeing the reverse of that. And all year people have been desperate to get back into bonds at every opportunity. And I think, maybe there's another opportunity now to get back in, but I don't think that's what you want to do sort of longer term.
So this would be, in your mind, even if like I'm using TLT for a proxy of the longer term treasury, even a rally back to 120, 130 is still a bear market rally. And maybe, we've seen the most of it here, maybe. So specs may consider shorts in bonds. You think long term, it doesn't make sense to be in bonds, even though they could rally 20, 30% off the lows. They've already rallied 10%.
Yeah, I mean, it's about horizon.
Yeah.
If we get some good inflation data in the next couple of months, and let's be clear, it takes more than one good reading. We did at least 2 or 3 for Fed officials to actually acknowledge that there's a genuine improvement in inflation. And then you've got terminal rates coming down, and that's a sort of opportunity to make some money in bonds. But over any sort of longer horizon, I think you just get absolutely killed in those
Dario,
markets.
yeah. Can I ask you if you think that there's a possibility of history at least rhyming compared to Volcker, where he started his tightening regime and then paused and then had to come in and be very draconian? Could Powell be on the same course that he wants to pause for a little bit, and then by next spring, the numbers aren't better because the dollar's weaker and it's pushing up nominal prices because of a weak dollar, and that he has to come back in sometime next year and start raising rates again?
I think that's definitely the sort of likely outcome.
Okay.
To believe that the economy could sort of seriously deteriorate and unemployment could start to go up, and the Fed would do nothing, there's just no chance of that. I mean, there is no appetite anywhere for big increases in unemployment. And they say they've learned the lesson from the 1970s and the 1980s. But you have to remember that back in the early 80s, we'd had 15 years of stagflation, and people were absolutely sick of inflation. You had the unions continuously on strike, and so there was sort of this political desire to crush the trade unions, and there was a sort of widespread acceptance that you needed big increases in unemployment to do that. And you had sort of Reaganomics in the US and Thatcherism in the UK. And this is just a different world. To believe that these central bankers are just going to say, well, unemployment is going up and that's great, it's just not going to happen. I think that they will capitulate very quickly. And obviously they deny that because at the moment they're very much focused on inflation. They're raising interest rates. They want everyone to focus on the fact that they're raising interest rates, not the fact that they'll be cutting interest rates. But if the economy really starts to crack next year, then they'll respond to that. They always do. And chances are they'll freak out and sort of overdo it. I mean, I actually think the economy will be quite resilient. I think that people are sort of too bearish about global growth prospects. If anything, everyone keeps revising up their forecasts. Look at Europe. The data keeps coming in a little bit better, and then people keep cutting their forecasts for next year. I think we'll see some resilience here, actually.
So you think risk, bonds are one story, and risk and equities, and it sounds to me like you would prefer equities outside of the U.S. Could that be because of dollar weakness? And do you think that the dollar, Dario, has put in a major top up here at this 114 level? Pretty vicious break we've had so far. Is that it for the dollar for a while?
Well, I think we're in a quite simple world to understand the dollar now, because we were in this reverse currency war, since we're really from the spring onwards. And it was never really credible, but central banks in Europe sort of peddled the idea anyway. and they believed that they could defend their currencies by matching the Fed one for one. So every time the Fed did 50, they did 50. The Fed did 75, they did 75. And I think they've got to the point now where these European central banks, apart from the ECB, which is still living in a sort of fantasy land, but the other central banks realize that they can't match the Fed anymore because their economies are much less resilient to interest rates going up. And so what we've seen is a bunch of central banks, starting with Australia, Canada, Norway, and then the UK. They've all sort of already pivoted. They've already signaled that the reverse currency war is effectively over. And the reason for that is that they've got massive domestic vulnerabilities, massive housing bubbles. Each of those countries is basically the sort of prime candidate for a housing bubble. And they've realized that that their economies are much more sensitive to rates because they have a lot of variable rate mortgages, and that's not a problem that the US has.
That's true.
So you think about the impact of interest rates going up. You have a sort of flow effect, which is the immediate increase in interest rates and the effect that has on mortgage activity and housing construction and all of that. We're seeing that everywhere. I mean, that's pretty universal, that housing markets are now under pressure. But then you have this stock effect, which depends on the nature of your mortgage market. And if you've got huge amounts of variable rate mortgage, like Australia, New Zealand, Norway, UK, Canada, then you get this extra effect because you're squeezing the incomes of people that already have mortgages, and you're pushing them closer to financial distress. So if you think about the sort of big short dynamic, what was the big short? Well, it was the sort of US hedge funds looking at US mortgages and figuring out that 30% of those mortgages had been variable rate. And they all timed that 2006 sort of ticking time bomb when all these mortgages were going to blow up. Well, you don't have that dynamic in the US at all, but you have it in a whole bunch of other countries. And those other countries have now realized that they're just at the mercy of the Fed here. And they've realized that their currencies are going down either way. Because, if they don't match the Fed, their currencies go down. If they do match the Fed, they blow up their domestic housing markets and their currencies go down. So those central banks have realized the futility of this, and they've all sort of given up now. And so now, currencies are just entirely a play on what the Fed does. If the Fed pauses or slows down its tightening cycle, that's going to take the pressure off all of these other currencies. If it doesn't, then those currencies are just going to continue to get hammered.
Well, they haven't been getting hammered for a while. I mean, the pound, you're in the UK, right?
Yeah.
Okay. So, what do you think about a 123, 124 pound from 103? Do you think that it's becoming overvalued up here?
Yeah, so I think, the pressures, I don't think it's overvalued. I think the pressure is coming off because of the Fed, because there's this perception that the Fed is going to slow down. There's this, the Fed is now clearly looking at the data again, which it wasn't doing for a period. And so the idea that the Fed is about to slow down is taking the pressure off all these currencies. In the UK, we were in this sort of ridiculous crisis for 2 months. And there's been a lot of stuff written about that, sort of fiscal black holes and the bond vigilantes, and all of that was nonsense, really, because all it was is that we had a very aggressive government, and it looked like the Bank of England would raise interest rates very sharply in order to deal with that. And at one point, we had a terminal interest rate of 6% in the UK. And there was no way that the Bank of England could raise interest rates to 6% without crashing the entire economy. We're looking at debt servicing ratios for households, jumping to sort of 50-year highs. And it was obvious to everybody that if the Treasury had continued on that path and the Bank of England had continued on the path that they were on, we were going to get, some sort of financial calamity. And so if you're an international investor, you just dumped sterling at that point. So what we've had now, because you didn't want anything to do with UK assets in that sort of environment, if the UK is facing this sort of immediate trade-off between price stability and financial stability, then you just dump it. So I think that we'd sort of oversold, and there was a sort of, we were just in a sort of crisis situation.
Yeah.
And that dynamic has been broken because the Treasury has reversed everything and is talking about austerity, although there's no genuine chance that the UK can do austerity. I mean, it's ridiculous, but they've managed to convince people that they will. And the
How can
Bank
they
of
do
England,
austerity with an energy crisis in the UK?
well, they can't. It's nuts, and at the moment they're doing, they're still doing more fiscal support. I mean,
Yeah,
even now as temperatures are dropping, there's a sort of
right.
tap of government money flowing into the economy with every degree that the
Yeah,
temperature falls. But they've
right.
managed, but the UK was becoming this sort of market narrative. We were this joke, and we have lots of clients based all over the world. They were continuously ringing me up saying, what the hell's happening in the UK? We'd become a market theme. And so what the government has managed to do is to stop us from being a market theme. And we've gone back to being sort of irrelevant again. Nobody's interested in the UK anymore, which is exactly what they needed to do. So they've managed to convince people that they're doing austerity. In turn, the Bank of England is signaling that it's going to be much more gradual with raising interest rates. They've made a real effort over the last sort of month to tell people that the market is too hawkish on interest rates and that they're not going to hike as quickly as the market expects. And so that sort of trade-off between financial stability and price stability has gone away, and gradualism has come back, and sterling is rallying on the basis of that it looks like, we're in a sort of more sensible world for policy. And it wouldn't surprise me if it ran further, but I think that we'd overshot, when when sterling had fallen to its sort of lowest level in history. we were undershooting, and we've just bounced back, and the government has done the smart thing, but we still have a fundamental growth problem in the UK, and there is no chance that austerity is going to happen. I think the government will have to do more at some point, not less.
Do you think the Fed cares about what's happening in the precious metal market at all? The recent rally in gold and silver, do you think it's just a spec play, but because central banks have been pretty heavy buyers of gold for years, but even really stepped it up over the last 3, 4, or 5 months? What do you think is behind central banks really being aggressive?
I don't think that's a big focus for them. I think that they've been looking at financial conditions much more broadly. I think that as investors, we sort of think that central banks are more interested in financial markets than they actually are.
Okay.
I think that we're sort of talking our own book sometimes with central banks. I think they, I used to work in policy making, and obviously they do look at what's happening in financial markets. But the idea that the Fed has to sort of target a particular set of financial conditions or target a particular level of the stock market, the fact that stock markets are rallying now is sort of unhelpful for the Fed, but I don't think they can really over-engineer that. I think the focus for these central banks is very much on the inflation that they have and on the level of interest rates that they believe they need to sort of deal with that inflation problem. And then everything else just drops out of that. And so, the idea that the Fed can't slow down its pace of tightening because, the equity markets might rally, I don't think they'll be looking at it that closely, actually. I think they'll be much more focused on interest rates, and they need to know that their monetary tightening is still where they want it to be. And that's much more about interest rates than it is about, any commodity
or equity index. Because, that has been bandied about by, some respected people like Julian Brigden, saying that the economy is so financialized that for the Fed to get employment down to the levels, or unemployment up to the levels they want, they would have to take the S&Ps down to 3,000, 3,100, the pre-COVID levels. You don't think that there's that type of linkage between the market and the economy, that it's so financialized, the economy, that lower stock prices are going to be needed for economic indicators to go their way?
I think it's, I think it's been helpful this year that the equity market has gone down. I don't think the intention was to sort of target the stock market in that way. It was also, I think they were also hoping that it would have some effect on labour supply as well. So there's this idea that lots of older people had retired because they could afford to, and maybe you could push those people back into taking jobs. But I think the focus is much more on interest rates. And when you look at the sort of transmission mechanism of monetary policy to the economy, it's coming largely through housing. So,
Right.
we're seeing this very aggressive deterioration in housing activity. Almost all of that is because of, what these central banks have been doing. And that's the bit that they need to sort of control. It's housing and durable goods. And I think if you start to get sort of job losses in those areas, then you get a sort of much more tangible impact on the economy than sort of indirectly through stock markets. I think they don't really understand the impact of stock markets on it sounds weird, but I don't think they really understand the impact of stock markets on the real economy. Is it wealth effects? Is it confidence? Is it balance sheets? It's all a bit sort of up in the air. And I think they're much more focused on the bit they understand, which is just interest rates, housing, lending. It's that sort of transmission mechanism.
Yeah. So really haven't had big price falls because of the factors that you mentioned about, most people in the US have, locked in their rates under, 3.5% over the last few years before this tightening cycle. And there's no way, unless they're completely unemployed, that they're going to lose those properties or sell those properties, because for them to even go out and rent, it would be twice as much for them to do so.
Yeah, but
how do you break a housing market that has that setup of being short housing stock and people locked in? Go ahead.
No, but so what they have done is they've killed transactions. So, new mortgages has tanked, house purchases has tanked, housing construction has tanked, any sort of employment related to those sectors has stopped. So they have had a very tangible effect on the economy, sort of directly through that channel. It's just a question of how far that goes, and do you start to see sort of big job losses in those sectors? And there are all these sort of potential spillovers that you can get, and you can get a sort of plain vanilla recession coming from the housing market without having the sort of massive financial distress that you had in 2008. And I think that's why the US looks a little bit different from some other countries, because the chance of getting sort of subprime dynamics in the US is pretty remote. But just through sort of construction and durable goods spending and furniture sales and all of that stuff, you could still have a pretty big effect on the economy. You could still slow down activity and employment in quite a big way doing that. But if you're Canada or the UK or Australia or any of those countries, you get that, but you get an extra effect, which is that you're squeezing the spending of anyone who owns a home. And if those people have over indebted themselves, and a lot of people have, then maybe you actually get financial distress on top of that.
Okay. All right. Interesting. Why don't we wrap it with what you said the Fed knows, and that's interest rates, 0.5 point for the next Fed meeting?
Yeah, I mean, it's looking that way. It's looking, but it doesn't help that they get the CPI data just before.
Right.
As I said, I think it's that they clearly want to slow down. I think that they've hiked a long way. They haven't really been assessing the impact on the economy. They know that there's these lags. They know that stuff is happening in housing. They think that labour demand is weakening, but it's not entirely clear. They'd really like to take stock of it. But, if they get a really nasty CPI print again, they're going to find it really hard to do that.
What's an investor to do in this environment, Dario? Do you think that it's more important right now, after this transition year, which is coming to a close, to be focused on return of capital instead of return on capital?
I think so. I think this is the most difficult environment. Well, I think this is the most difficult environment I've ever seen. I mean, I've been doing this 20 years. I've never seen an economy as confusing as the one that we're in right now.
Yeah.
Investors are constantly saying to me, where are we in the cycle? Well, the fact that they're asking that question just sort of highlights how difficult this is, because this isn't really a cycle. No point has this been a normal business cycle. This is sort of messed up, pandemic affected, war affected global economy.
Yeah.
And it's really difficult. And central banks have sort of added to the volatility by freaking out about inflation this year and raising interest rates too quickly. So all of this stuff has to unwind. I feel much more certain about where the world is going sort of over the next 2, 3, 4, 5 years than I do where it's going over the next 6 months, which sounds bizarre, but I just think we've got these massive distortions in the economy. And as these distortions unwind, this data is going to be all over the place. I think it's just going to be a world of huge volatility.
Optimistic after we get through this 6-month period?
I think so. I think that I think it's going to be very different. So, I think we're in that sort of secular higher interest rate world. I think inflation will be higher, but it will be more volatile, which is probably the biggest story there. But I think it changes everything for investors because, for the last decade,
you can't
as
just
an investor,
buy FANG.
You just put money into US tech and you just watched it getting continuously re-rated. And this is going to be a much more difficult world, but there's going to be huge opportunities in that, globalization, climate change, reshoring, building back of manufacturing. There's going to be plenty of opportunities out there for investors. It's going to require a little bit more sophistication than it did.
Yeah, you're actually going to have to do some work.
Yeah, and a lot of investors are sort of value investors or bottom up, and they've got absolutely hosed, and they've just seen sort of a younger generation of investors come through that have just been putting money into Tesla or whatever and watching it go to the moon. And they've been utterly frustrated over the past decade, but that decade is really unusual. You can look at sort of the composition of the stock market going back to 1930s. That period where growth just absolutely killed value. It's just incredibly unusual. And it is just a feature of a sort of lukewarm, disinflationary economy with a horrible policy mix. And I think, that world is gone. And I think it's going to be very different.
Okay. Well, it's great to have you come and edify our community about these things because we don't feel alone when we hear about all these people that are confused about what to do intermediate term. We have to get through the mud of the next 6 months, according to you, Dario. And you're a great watchman for the FinTwit community and appreciate you giving your time and explaining what you see to us every time you're here.
No worries. Good to talk to you.
All right, Dario Perkins, everyone, and you could follow him at Dario Perkins, right? Best place for people to ask you questions or get a hold of you. Is that correct?
Yeah, Twitter's the best place. I'm on there quite a lot. And
all right.
Yeah.
All right, you tweeter. Happy holidays to you, Dario.
You too.
And Happy New Year. Thank you very much for being here today and look forward to talking to you in a few months.
No worries. Take care.
All right, Dario Perkins, everybody. And everyone could join the team in 15 minutes on the Morning Edge. You're welcome. People appreciate that you were here. And Dario, and I'll see everyone tomorrow for Turnaround Tuesday. Adios, everyone.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.